This is actually a new series that I'll be creating, the Spotlight on Business series, and this one is the first of those, Spotlight on Financial Statements. And as Caroline said, my hope is to make this fun. A little bit about me. I've had an extremely varied professional career, but among all the different positions that I've held, for about 7-8 years, I was a commercial lender and branch manager at a couple different banks, and became a finance education expert within my last bank. So I was tagged to be the next trainer for that organization, and then the recession came and everything got turned upside down. But I do love training, and I do love financial statements, and I'll tell you why here in a little bit. So today I'm going to share just a tiny bit about the Sbdc in addition to what Caroline's already shared with you. And then I'll talk about financial statements and the stories that they tell. I'm going to keep all of this very brief because most of our time is going to be in that third bullet point, building statements from scratch. This might sound like drudgery, but my hope is it'll be enjoyable. My goal is to help you come away with some very basic understandings about financial statements. I'm not expecting you to be experts at the end of the next 45 minutes. That's not going to happen. But a better understanding of what financial statements are telling you is what we're going for today. And hopefully there'll be a little room for discussion, and then I'll just recap with our key takeaways. So, very little bit about the Sbdc. Sbdcs are all over the country. We've been around for 40 years, 37 years in Oregon. And I'm proud that the Sbdc actually launched at Lane back in 1983 in Oregon. And we are in 19 centers around the state. They're all attached to what back in 1983 were all community colleges. And we are funded by primarily, at least I am funded primarily by the college. We also get significant and meaningful grants from Business Oregon and the US SBA. The SBA sort of controls what we do, but primarily our job is to provide free and confidential advising with people who are either going into business or are in business and have run into a roadblock. It's our job to help them get past roadblocks. So that's the Sbdc. No matter where you are in the state or even the country, there should be an Sbdc that can serve you. So financial statements and the stories they tell. I actually was a music composition major in college. That's what led me here. And the reason that's important is because learning music at a young age, I have an affinity, I developed an affinity for language and recognizing languages. And I didn't realize, because I learned to read music at such a young age, I was in college before it struck me that somebody could look at sheet music and have no idea what's on that page. It's just gibberish to them. And I don't know why it took me so long to realize that, but it took me that long. Financial statements are the same way. You know, we have all sorts of different languages that we learn as we grow and progress. Music is one that I've learned. Some learn sign language, and we all have the language of emotion. You know, these are all different languages. Another thing I didn't realize until late was that when I was a banker, I learned financial statements, and only at that point did I recognize that reading financial statements is like reading a story. And if you have financial statements that are put together well, then if you understand that language and you take a look at the profit and loss and the balance sheet and the cash flow statement, as you look across those, you can tell the story of what's going on in the business as if you were reading a book. And that was enlightening to me, and something that I love to share with my bank clients was the story that their financials were telling me, because in many cases they didn't know that story. They certainly didn't know that this financials, that was embedded in the financials. So that's one of the key messages I want to get across today, is recognizing that financial statements do tell a story. It is a language. And again, I don't expect every business owner to be expert in financial statements, but to understand at least the basics. So you can, it's like me reading Spanish. I've got very minimal Spanish language ability, but I can actually read Spanish and figure out what's being said in a paragraph. To get to that level of understanding with your own financials is valuable for you. So the income statement. There are three different statements, as I said. Income statement, also referred to as a profit and loss or P&L, and then there's the balance sheet and cash flow statement. The income statement looks basically like this. Typically, it's in one long column. I split it up so I could put it on one screen, but it's a fairly simple document. It begins with your sales, and then below that are all the expenses. There's usually a place for other income and expenses, but the income statement is all about the actual revenue generating activity of your business. It's about the transactions. It's about producing your goods and selling your goods, or providing your service. And as we're going to see, not all transactions in business actually show up here. But this is a basic income statement. I'm not going to go into this deeply because we're going to be talking about this more as we build out our financial statement. But basically, an income statement shows you business activity over time. So it's the action statement. This is what you did over that period of time. The balance sheet is entirely different. The balance sheet is kind of like in this picture. If you look at this, you can't tell whether this ball has just been thrown or if it's dropping into his hand. In fact, it might actually be going sideways and you just happen to catch it here. You really can't tell. All you've got is this moment in time. This is where this ball is in position to that hand. That's all you can tell. A balance sheet is the same thing. All it's doing is providing you a single moment in time. If you don't have a previous balance sheet to compare it to, you can't tell trends. But it is an important sheet because what this is telling you is essentially what your asset balance is, how much you actually have in value within your business, and that's on the left-hand side of the sheet. Your current assets, these are things that can be quickly converted into cash, and then your long-term assets for a total. And then on the other side, you've got your liabilities on top. This is how much you owe, the different things you owe to others. And if you take all of your assets, everything that your company has of value, and you subtract how much you owe, down at the bottom, you're left with your equity, the net worth of your business. So, and that's why it's called a balance sheet, because by definition, the left side, your assets, will always equal your liabilities plus your equity. So it's always in balance. If your balance sheet is ever not in balance, something is severely wrong. Now, understand, we are going to build our financial statements sort of by hand today. I would never expect you to do that. No one would ever expect you to do that. Now, people use QuickBooks or some type of accounting software, and that software will typically build your financial statements for you. But that creates a problem because they're being built for you. You don't necessarily might not necessarily feel like you should even understand or know what they're saying. You just build them and give them to the bank or give them to the CPA. It is essential that you learn what they're telling you because these are your primary business management tools. So a balance sheet provides your business condition at a single point in time. That's what it does, in comparison to the income statement, which provides your activity over time. So again, your income statement is essentially an action report, what happened. And the balance sheet is a snapshot, single point in time. And finally, the statement of cash flows. People don't spend a lot of time on the statement of cash flows, but it can be a valuable tool. What happens is, because not all transactions show up on the income statement, some show up only on the balance sheet, you might not actually know what's going on in your business. The statement of cash flows is actually what tells you how a transaction on your balance sheet impacts your net cash, or how your income statement impacts your net cash. And as we'll see through this process, the cash that you have in your business is not the net income at the bottom of your P&L, at the bottom of your income statement. It is not, and sometimes it can be substantially not what's actually showing on your income statement. So it's important to recognize that. You have to monitor cash because cash is what you use, and the cash flow statement can help you do that. You'll notice these are entirely in blue. That is because we aren't going to put anything directly into the cash flow statement. That will all be automatically generated from the transactions plugged into the balance sheet and the profit and loss. So the statement of cash flow shows how cash flow runs through your business, how it flows through your business. Now, there is a quick difference. In another training, you might do cash forecasting, or your cash forecaster or cash budgeting. That document looks different than a statement of cash flows. Just know that there are two different documents. We're not going to talk about cash forecasting today. We're going to talk about the basic financial statement. So how do these financial statements emerge? I am going to share a different document now so that we can work through that. And it is right here. Forgive me, I lost it for a second. Here it is. All right. So hopefully you can all see this. You can get the window, all the little video windows out of the way. So this is a basic Excel spreadsheet that I've generated that does some auto population. And what we're going to do is we've got a blank income statement, a blank balance sheet, and a blank statement of cash flows. And what I'm going to do is I'm going to give you transactions, standard business transactions, and we're going to see how these impact these statements over time. So we're going to start with the first one. And what I'd like for you to do is if you have input, if you've got an answer for me, if you think you know where something goes, or even have a question, go ahead. And this is a time for you to be interactive, so don't hesitate. So let's start. So you're starting a business, and you know you've set aside some money. So now you're going to transfer $10,000 from your personal account into your business account to get things rolling. So the first question I would ask is, does that show up on the income statement? The investment of your cash into your business. Anybody have a question, a yes or a no? And it's okay if you don't. So I will tell you, this is the first no. Again, the income statement, as I said earlier, this describes your revenue generating activities and the expenses associated with your primary work. An investment in your business is not seen as that. It's over here on the balance sheet, and it's paid in capital. So this is where you would plug in your investment in your own business. When I plug that in, it shows up over here on the other side under cash. Well, obviously now the business has cash. How did it get there? The statement of cash flows actually shows you that you paid in capital of $10,000, so you have an increase of $10,000 in cash. And so that's how it ends up showing here on your cash. In fact, we're never going to plug money directly into our cash account. This cash number is going to be developed from the transactions. And over here on the income statement, we've got nothing because we actually haven't had any transactions yet. So the next thing we're going to do is you got to get equipment, because you build widgets, just so you know, in case you didn't know that. You build widgets, and whatever a widget looks like to you will be fine. So you need a widget press, and it's a $12,000 piece of equipment. You actually do get a $9,000 loan for that. So you've got a $9,000 loan giving you, and that gets you a $12,000 widget press. Does that show up here on your income statement? And feel free to unmute. Let me know what you think. I can't actually see you, so if you're giving me thumbs up or down, I can't see that. Anybody have an idea?
Would that fall under miscellaneous expenses?
That would be an excellent place for it. However, it is not, in the same way that an investment in your business is not an activity. The purchase of fixed equipment, the purchase of the equipment that you need to run your business does not show. It's not a sales related transaction. So it also is over here on the balance sheet. So in order to get that piece of equipment, you had a, yes.
Robert, just to let you know, Andrea and Alan both said no to your question in the chat.
Excellent, thank you.
So that would count as an operating expense.
So it would not, the purchase of fixed equipment would not be an operating expense. It actually shows up over here as fixed assets. So you've just brought in a $12,000 piece of equipment. Obviously, you didn't have enough cash to pay for it. Thankfully, you got this $9,000 loan, which you put over here under long-term debt. You still didn't have enough loan to pay for the whole thing, so that reduced your cash amount from 10,000 down to 3 because you did have to put 3,000 toward it. So now you've over here, you've got, you should still have this paid-in capital of 10,000 reflected. You've got a $9,000 loan, and you've got $19,000 in total assets. You've got 7,000 remaining in cash and that $12,000 piece of equipment. You still have nothing here on the income statement. So no income statement yet. Now, you purchase $5,000 in raw materials to create your widgets. Again, the question is, would that go here on the income statement? And this is a bit of a trick question, because if you know that the raw materials is a part of your inventory and you see inventory up here, you might go, oh yeah, so I've purchased inventory, I'll put it here. This is the first thing about the income statement that's important to recognize in this interaction, and that is cost of goods sold reflects the amount of inventory or other costs directly associated with the production of your goods. But it only reflects the amount represented within your sales. So you don't actually put inventory purchased here. Once you make a sale, the ratio of that, the amount of that sale that is a cost associated with inventory will show up here, and that'll be clearer later. So even though this says inventory here on the income statement, because you haven't made any sales, there's no inventory expense to reflect here yet. So again, go to the balance sheet, and you've got inventory over here. You've made a $5,000 purchase in inventory. You've reduced your cash down to $2,000, and nothing else changes. All you've done is convert $5,000 in cash into $5,000 in inventory. Everything is still in balance. Nothing else has changed. Quick check at the cash flow statement. It's gotten a little bit more complicated now. You show a use of cash here for inventory purchase, the use of cash getting that piece of equipment, and then where all that cash came from is over here. So next thing, you spend $2,700 for marketing and putting your website in place. Now, this is finally a transaction you would put on your income statement under marketing, say $2,700. So that doesn't look good because now all you've got are expenses associated, but you had to do that to get your business underway. So if you've got no net profit, where did that money come from? Well, it came from your cash account. Unfortunately, you only had $2,000 to start with, which was on your balance sheet here. So you've overdrawn your account. What happens? Well, your bank caught that for you, and that you had a little overdraft protection account. So they actually gave you $700 in a little line of credit to cover that. So you're back to zero. But you now have this little note payable over here. That in the loan, the line of credit does not show up anywhere on the income statement. It's just over here as a liability, something you owe. So you realize you're going to need some more cash because you still haven't got any transactions, and you've still got more work to do before you get them. So you go to your partner and you say, hey, I know we put 10,000 in. I really think we need another 5,000 to get this off the ground. They say, great, go to it. So now instead of 10,000 in paid in capital, you've added another 5. So you've got another $5,000 to work with in paid in capital. And as you would guess, nothing of that shows on the income statement, but now you do have some more cash. So that's all good. Yes.
It looks like there's a question in the chat. Alan,
Okay.
did you want to unmute and ask a question?
Yeah, thanks. So going back to that inventory one, I had a question.
Yeah.
Maybe I misunderstood it.
Okay.
It sounded like you bought materials to make product with, which to me, I'm no accountant, but to me would be some kind of operating expense. And I always thought of inventory as completed products that you've made that are sitting on the shelf waiting to go. So maybe I'm wrong on every count, but the way I heard it, the stuff you use to make the stuff is a supply and would be an operating expense. And then when the thing is sitting on the shelf, taking up space, it's inventory. But maybe I'm wrong.
So
Yeah, and I had a follow-up question in the same
Yeah.
line, because
Yeah.
I thought sort of the same thing. Is this an example for accrual-based accounting? Because I thought that what you showed is what I do currently for accrual-based inventory, but I thought for cash-based, it was sort of just a direct deduction of cost of goods.
yeah, you know what? I am working it. I didn't mention that. Thank you for bringing that up. I did mention that as accrual. I'm sorry, I did not mention. My presumption in all of this is accrual. My apologies for not putting that, making that clearer. So
Okay, so that's why I got
Yeah.
confused, because I've run a bunch of places, and 99% of them have all been cash accounting.
yeah,
I've done some nonprofit healthcare stuff, but I wasn't the financial manager, and I never really got the accrual. So now the way, if you describe it that way, I guess the materials you use are part of the product you're building, and I guess then it's okay.
yeah.
Okay.
It does live as direct
Okay.
costs associated with inventory.
Now I see it.
Yeah, and if I have time, let me find that and just validate that for all of us. But that's you would not put general you would not put expenses, raw materials here under operating expenses normally.
Can I
Um,
ask another question?
yes.
What determines if you're going to go with an accrual-based system versus a cash-based system?
So the fundamental difference between these two, and it's really it's important to understand, is that with accrual, you are acknowledging the revenue or expense at the point that it is earned, at the point that is actually happening. So that means once you, in the case of,
I mean, I know what it
intellectually-
is. I'm just wondering which industries or what situations make you want to go with accrual, which I've only done in nonprofit, versus cash, which are pretty simple businesses that I've always done.
Yeah, and I think that's the thing, is the simplicity of the business. If the transactions are very simple, and especially if you're receiving cash or paying out cash fairly close to the time of transaction, then a cash-based business makes sense. The challenge is once you get to a more complicated business, and you're actually trying to, at any given time, show the real value in your business. The amount of transactions that have happened, but cash hasn't actually changed hands yet, can significantly change what a business looks like. And because you might have, go ahead.
Things that you produce where you spend a month producing it and then it doesn't sell for a year. There's a big production process and it sells later.
Yeah.
That's the kind of thing.
Yeah.
I can give a really strong example. So my business used to be cash-based, right? And then we launched a big Kickstarter in December. Our fiscal year is on the calendar year. I switched to accrual because if I had to pay, I wasn't going to be able to manufacture with the money I received until the next year. And if I stayed with cash basis, I'd owe like $30,000 extra in taxes. By switching to accrual, I was able to say, I'm recognizing this as customer deposits, and then later on recognize that revenue once we had paid for the costs, and therefore pay less taxes. That was one example in my company. Sorry to interrupt you, Robert.
No, that's fine. That's a great example.
Didn't mean to disturb you. I was just curious.
Well, and in many cases, often a business will move from cash to accrual when there's something like that facing them. When they actually have a big tax implication, they can move to accrual and save for, at least at that moment in time, it helps them out. You can't go back and forth to take advantage of that. You can yeah. So I'm sorry. I was just double checking that yes, your raw materials, that still stuck with me for some reason. You had me doubting myself. Raw material costs do show up under cost of goods sold. So
I have a question.
Yeah. Yes.
I actually have I have a few different businesses that I'm involved in. So one is a secondary retail business, used bookstore. Another is a personal service business.
Mm-hmm.
Would I be better off doing the retail business as cash and the personal service business as accrual? Should I do both as accrual? Which would be beneficial? Which system would be beneficial to an inventory-based business versus a service-based business?
So well, service-based businesses are easier to run, it can make a lot of sense to run a service-based business as cash, especially if you're getting paid quickly. Typically, I encourage businesses or any business owner to consider accrual-based accounting, because I feel like, in my opinion, and this is from my banking career, with accrual-based accounting, and when I'm looking at a set of financial statements, I can actually tell what the business, what the state of the business is, with a little greater degree of comfort. If you have a lot of transactions, or if you have large transactions and you're in cash, I might not know of a significant transaction. That significant transaction might not be reflected in your income statement yet, because you haven't received cash. Or because if there are large transactions, when the cash comes in, it might not match the same time period that you actually did the work. It's just harder to track the operations of a business and how well you're doing with cash accounting. So I generally lean in that direction for everybody. But with a fairly simple and especially a service-based business, I think cash is fine. It's my thinking, and I'd happily accept anybody's other opinion on that if you want.
I would just say a service business sounds to me a lot like a type of a healthcare business, and the flexibility of taking your cash where you want it to be at the end of the year is so easy. You can manipulate it exactly how you want, and I don't know how you would do that accrual wise, but cash wise it's really simple. So
Excellent. Thank you for that. All right, so I'm going to go a little bit quicker now so that we get through this, because I do want to get to the end of building this out. So you just paid in $5,000 more in capital here, and you recognize that you're paying some utilities which you've been holding off on of $1,200. Those actually do show up here they are on your income statement. In addition, you go to an event, and this actually happened at a business I worked at in the late '80s, where he went to a conference, and went there with really no expectations, but he had this great idea for a product, and he came back with $250,000 in orders, and nobody expected that. So in your case, I'm going to say you come back with $50,000 in orders. So the first question I have is, are those orders, do those orders get reflected here? Any thoughts? Do they get reflected on the income statement? And the answer is no, because they're not actually sales yet. You can't put them down as sales until that order is fulfilled. They actually don't show up anywhere. They are just promises, but you do have to fulfill them. So how are you going to do that? Well, for $50,000 in orders, you need to generate $20,000 you have to have $20,000 in inventory. You've got a 40% inventory cost. So you obviously don't have $20,000 in inventory. You've only got 5. You've only got 3,800 left in cash. How are you going to do that? You go back to your partner, and your partner says, no, this is as much as we've got here. So you go to OAME, the Oregon Association of Minority Entrepreneurs, because you hear that they have a loan program that will lend against orders for clients that fit their pattern, and they do. They'll lend up to 80% of an order. So you go to them and they say, sure, we love what you're doing, and we'll give you a $40,000 line of credit basically to cover your $50,000 need. So you don't need all $40,000. It's sort of given to you as a line. You go over here to take out, say, $15,000 to cover the rest of the inventory you need. So you plug $15,000 here into the notes payable, but you realize you were supposed to have paid off that overdraft protection as soon as you had cash. So the first thing you do is pay that off, and then you borrow $15,000 from that line of credit. Now you've got cash here, and you use that $15,000 to supplement your inventory amount. So you create $20,000 in inventory. And I realize I am simplifying the concept of inventory from raw goods or materials to creation. But let's I'm just saying that I'm lumping all of that together in a single piece, and I might actually follow this up with a little white paper on what that looks like. So now you've got 20,000 in inventory. You still have nothing showing over here on the income statement, but you have finally fulfilled those orders. So you've got 20,000 in inventory, which allows you to send those out to all of the order clients that you had. Congratulations, you now have $50,000 in sales. So excellent. We finally got something positive here on the income statement. And that is all good. It looks like you're doing great. Go over here to the balance sheet. Oh, look at all this cash. But wait, you don't actually have that cash. And you realize, well, yeah, I guess I didn't actually get cash because 40,000 of that 50,000 I actually allowed them to buy on credit. So I have accounts receivable now for $40,000. So I don't actually have $53,000 in cash. There's no place on here on the income statement to show that, right? So it looks like you've got this great net profit number, which you do. But you have to recognize that that doesn't mean you got that much in cash right out of the bat. You actually took in $40,000 in accounts receivable and only $10,000 in cash, right? So this is excellent, excellent sale, but it does not immediately lead to an increase in your cash, and that's important to recognize. You also, and don't tell anybody you did this, but you had a family friend who's been working with you, and you agreed to pay them $1,000 a week to come in and help out in the office and do things. Well, you now have sales, and they say, hey, you need to be paying me, and you owe them. This is a 6-month period, so you owe them $26,000. Well, you agree to pay them, but you didn't have $26,000 because you hadn't collected all that cash yet. So you advance some more on your line of credit. And let's say you advanced, say $18,000 on your, oh, sorry, that should have been 33. 15 plus 18 is $33,000 on your line. That gives you a little bit more. You go over here to the income statement. You realize once you make that once you acknowledge that, you also have taxes, payroll taxes to pay along with that. So you've got another $4,000 there. This is beginning to look a little bit more like a normal income statement. And this is beginning to look a lot like a balance sheet. The challenge we have here is we've got a $50,000 sales, and we've already got $33,000 in a short-term note. Got to take care of that. So you spend time working on collecting your AR, collecting the accounts receivable. And by the end of this period, you're able to collect almost all of it. you collect $37,000. Again, none of that activity shows up over here in the income statement, but it does reduce this accounts receivable number down to $3,000. So that collection of money shows up in your cash, and that's looking better. So you now have cash. One of the biggest concerns that banks have with newer businesses is use of short-term debt. It was very common as a banker. We actually had a term for what was called permadebt, and this is for businesses who take out a short-term line of credit, but then they don't pay it off. They just keep advancing off of it until it gets maxed, and then they just sit there and they pay interest year after year on that line. That is absolutely not the right way to use a line of credit. You should pay it down as soon as, so a line of credit should be used for a specific purpose, and once you obtain the cash for that purpose, you should pay it back off. So you now have the cash associated with this transaction, and that was the reason you got this note. So you pay that off, and now you have what is a very reasonable looking balance sheet for a startup business. So that's all looking better. So I'm actually, we got 10 minutes left. So I'd like to just talk about this balance sheet or this income statement for just a couple minutes. Are there, and what I want to ask about is if there are any errors or items of interest in here that come to mind. Is there anything that comes to mind when you're looking at this that you wonder about or have questions about?
I'm curious, these examples that you're showing us here, the income statement, balance statement, statement of cash flows, would this be weekly, monthly, quarterly? I mean, what would this be a snapshot of?
Yeah, that's a great question. What I was doing is providing, I was thinking in my head of about a 6-month period for startup. And so I wasn't going through every transaction weekly. I was looking back on the last 6 months with a general timeline and just plugging in numbers kind of in the order that they would come. Obviously, you wouldn't wait till the end to pay wages all at once. You'd be paying over time. But what I really wanted to do is to show the implications of each of those transactions and how they're reflected here. So a couple things, we now do have, oh, you know what? I did not do something here. I should have put under inventory, when we finally fulfilled those orders, that is where we then show the cost associated with that inventory. It shows up as this negative cost of goods sold, or this cost of goods sold here. So that's why this wasn't right. So we did have an excellent sale here, but with all of this, we ended up with a net loss. And there are some things that when you look at this closely that aren't reflected in here. For example, with wage expenses, there would be workers' comp insurance that would have to be in there. So there's another few $100s of workers' comp that's not there. There should be insurance. Obviously, there are probably some office supplies. So there are definitely some things that are not reflected in here, which would even reduce this net profit number. So when you look at this, you might go, well, should I be doing this at all? But you could also, if you think about this from the perspective of using this and learning from it, there's some excellent potential learning here. The first thing is that if you went to a conference on a weekend without any expectations and you came back with $50,000 in orders, you could probably increase your prices a little bit. So that would be, if you're trying to figure out how to modify this to succeed, you know, you might change this to say $60,000 in orders. You know, maybe you have the capability to do that. In addition, you paid somebody $1,000 a week, which is pretty good wage for somebody in a brand new business startup. That number could get adjusted, or you might be thinking that you want to be able to do this full time. You're actually paying somebody else because you've got another side gig or another job you're doing. You want to be able to do this full time. You know, what would it look like if you paid yourself this, that would wouldn't eliminate it, but you wouldn't be paying somebody else. You could pay yourself that amount. So if I were to eliminate that, that would come out to you directly out down here under net profits. And if you were to make that adjustment in prices, and that was for 6 months, let's double that for a year, you're at 120. I'm not going to change all of these numbers, but that's getting up into the $70,000 range. So that might actually be a business that with a couple modifications here, if you could make that price point work and keep this inventory expense where it is, it might work for you. So it didn't look particularly wonderful at the end of that. So we had 50,000 here, 26 and 4, but it's still a viable business. We just need some modifications. So
there's two good questions in the
yes.
chat. One is someone asking if they can have this spreadsheet emailed to them. They would love it. And
okay,
then,
I could do that.
sweet, thank you. And then another one is, how do you account for an owner-operator salary?
So that depends entirely on the type of business you're building. If you are a sole proprietor, you are probably not going to pay yourself a salary here. That's typically what happens there is you take all of this and you put it on your Schedule C for your taxes, and the net income at the bottom is what the IRS actually thinks of as your business. If you are paying yourself, it actually comes out of here over on owner draw. So you can, if you're an S Corp or other business model, you can figure out a way to pay yourself. But very often with startup businesses, sole proprietorships, single member LLCs, that actually shows up here under owner draws. And even in a partnership pay looks similar to this. So, if you paid yourself $15,000, you paid yourself basically, minus $15,000. You tried to take everything back out of the business, obviously you'd be in a world of hurt there. So just realized I did when I forgot to put this inventory here, and then I did plug it back in, I also needed to go back over here and adjust my inventory back down to 0 because I've actually used it all. So, but great question about the owner draw. It's actually showed here on the balance sheet.
And Robert, we've got one other question.
Yes.
Which is a general question. How can people get connected with the Sbdc?
So I'll go back to let me go back to my PowerPoint, and because all the information's right there. I think this is it. So you can reach out to me at just killenr@lanecc.edu. You can also just go to lanesbdc.com, which is actually here on my video, lanesbdc.com, and you can sign up for advising. You can see what classes we're offering, all of that. I know we're right at the end here. I just did want to go through these key points that I'm hoping to make through this presentation. The first is to recognize that your financial statements are telling a story from 3 different points of view. You actually need all 3 of them to get a complete picture of your business. But once you learn that language, it can be really enjoyable to read financial statements, believe it or not. Not all business transactions are found on the income statement. That's very, very important to recognize. A profitable business can and often will have cash flow challenges. So even though you have profitability, especially if you're allowing people to buy on credit, you can run into cash flow problems very quickly. So you need to be able to project those out and plan for them. And ultimately, the financial value of your business, its equity or the net worth of the business, is all of what you own in assets, all of your value in assets minus your liabilities. And that's the basic balance sheet model. So hopefully some of that stuck. I realize I went through a lot of information here. The idea was to familiarize you with these statements. I hope that's been of benefit.